Introduce. Modern banking wasn't born overnight. It grew through empires, wars, and revolutions, changing how we use, trust, and control money today. In the 1600s, banks rose to power as empires expanded. Amsterdam and London became financial centers that funded trade and colonial wars. Revolutions forced banks to evolve. France and America needed new ways to fund themselves, leading to paper money and central banking. The industrial age created demand for credit. Powerful banking families like Rothschilds and Morgans financed factories and reshaped markets. By 1900, banks were global forces. They shaped nations, backed governments, and laid the foundation for today's economic systems. Empires, charters, and the birth of modern banks. The rise of central banks, 17th to 18th century. Central banks emerged to fund wars and stabilize currencies, starting with the Bank of England in 1694, blending finance with state power. The modern central bank was born in 1694 with the founding of the Bank of England, created to fund war and manage the nation's growing debt. Its mission: lend to the crown, stabilize currency, manage national debt, and lay the groundwork for modern state-controlled financial systems. Unlike earlier banks, it could issue notes, early paper money backed by government credit, making transactions faster and trust more widespread. Its model influenced other nations. Sweden followed with its own central bank, then France, and eventually the United States adopted the concept. Central banks became vital in war finance, shaping monetary policy, managing national debt, and building public trust in currency systems. Amsterdam and the Dutch Financial Revolution. Explore how 17th century Amsterdam sparked a financial revolution with the world's first stock exchange and modern banking practices. Amsterdam's Exchange Bank, founded in 1609, stabilized coinage and boosted trust in international trade by offering reliable currency exchange. It accepted deposits, cleared bills of exchange, and focused solely on financial stability, issuing no loans but building public trust in money. The Dutch East India Company used banking innovations to fund massive maritime ventures, paving the way for the world's first multinational empire. Joint stock companies emerged, letting investors buy shares and fund global trade ventures, spreading risk and fueling economic expansion. Banking now powered imperial expansion across continents, financing wars, colonies, and global trade, not just small-scale local commerce. France, Italy, and revolutionary ideas. In France and Italy, revolutionary ideas reshaped banking, introducing paper money, state control, and the push for economic equality. In 1716, France's Banque Générale tested paper money to boost the economy, but speculation and mistrust led to its dramatic collapse. Its failure sparked public distrust in paper money, but also pushed nations to reform banking with stronger central oversight and regulation. Italy's city-states lost power as trade shifted west, but their banking systems, contracts, and credit methods shaped modern finance for centuries. Napoleon later established the Banque de France to stabilize the economy, restore trust in money, and centralize financial control after chaos. Across Europe, banks began partnering with state power, financing wars, managing national debt, and influencing economic and political policy. Capitalism, crashes, and credit, 19th century banking boom, industrialization and commercial banking. Industrialization fueled demand for capital, leading to the rise of commercial banks that financed factories, railroads, and mass production. The 19th century brought rapid industrial growth, and banks expanded alongside it, funding factories, trade, and large-scale infrastructure. Banks now provided business loans, managed personal savings, and financed massive infrastructure like railways, fueling rapid industrial growth. London became the world's financial capital during industrialization, home to banking giants like Barclays that financed global trade and empire. American banks like J.P. Morgan played a key role in building industrial empires, financing steel, oil, railroads, and massive corporate growth. The connection between capital, innovation, and banking was now complete. Banks became engines of progress, funding new industries and ideas. Savings banks and the common citizen. Savings banks opened banking to ordinary people, encouraging thrift, financial planning, and a sense of security for the working and middle class. For the first time, working-class people were encouraged to save small amounts, building financial habits and gaining access to secure banking. Postal savings banks emerged across Europe and Japan, offering secure savings options and promoting financial habits among everyday citizens. Women and rural families, once excluded from finance, could now open accounts, save money, and gain control over their economic futures. This shift slowly democratized finance, giving everyday citizens access to banking services once reserved for merchants and the wealthy elite. A financial safety net was forming through savings banks and insurance, offering security to many, even as economic inequality continued to rise. Crises and regulation. Financial crises exposed the risks of unregulated banking, leading to new laws, oversight, and the push for safer, more stable financial systems. Booms and busts became more frequent as speculation soared. Overinvestment and risky lending often triggered devastating financial crashes. Panics in 1837, 1857, and 1873 exposed the fragile nature of early credit systems, triggering widespread bank failures and economic downturns. Banks had no insurance, so if they collapsed, depositors could lose all their savings, fueling panic, bank runs, and widespread financial chaos. Governments began to regulate banking, introducing oversight, deposit protection, and central controls to prevent collapses and restore trust. Central banks re-emerged as lenders of last resort, stepping in during financial panics to provide emergency funds and prevent total collapse. Banking in a globalizing world, 1900 to 2000. Two world wars and the rise of state-controlled finance. Two world wars forced governments to take control of finance, regulating banks, printing money, and directing economies to support total war. Both wars demanded massive financial mobilization. Central banks managed debt, controlled inflation, and kept economies running under pressure. War bonds, rationing, and fixed exchange rates became common tools as states mobilized entire economies to finance and sustain the war effort. After World War II, the Bretton Woods system was created to stabilize global finance by fixing exchange rates and anchoring currencies to the US dollar. The US dollar became the world's reserve currency after World War II, backed by gold and trusted globally for trade, investment, and stability. State oversight of banking grew through regulations and controls, while international cooperation increased to stabilize global finance. The Great Depression and banking reform. The Great Depression exposed deep flaws in banking, leading to major reforms like deposit insurance and tighter regulation to restore trust. The 1929 Wall Street crash triggered panic, wiping out savings and causing thousands of banks to fail, devastating economies worldwide. To restore public confidence after widespread bank failures, the U.S. created the FDIC in 1933 to ensure deposits and protect savers' money. The Glass-Steagall Act separated commercial and investment banking to prevent risky speculation and protect everyday depositors' money. Globally, banking divided. Some systems prioritized conservative protection, while others chased capitalist growth and high-risk innovation. The key lesson: trust in banks depends on a balance, freedom to operate, but with clear limits to prevent collapse and protect the public. Post-war boom and global institutions. After World War II, global institutions like the IMF and World Bank emerged, driving recovery, trade, and a new era of international financial order. The World Bank and IMF were created after World War II to stabilize economies, support development, and prevent another global financial collapse. Banks could now move money across continents in minutes, not weeks, transforming global trade, investment, and financial connectivity forever. Credit cards emerged in the 1950s, revolutionizing consumer finance by extending purchasing power and introducing a new era of personal credit. Electronic banking began in the 1970s, introducing ATMs and digital transfers, laying the groundwork for today's fast, connected financial world. As economies connected, global banking grew to match, spanning borders, enabling trade, and shaping finance on an international scale. Deregulation, digitalization, and the 2008 crash. Banking in the late 20th century. Banking in the late 20th century saw rapid globalization, digital technology, and deregulation reshape finance into a fast, interconnected system. Deregulation swept across the US and UK in the 1980s and 1990s, removing barriers and allowing banks to grow, merge, and take greater risks. Fueled by deregulation and digital tech, colossal banks stretched across continents, stacking complex products into a vast global lattice. High-risk subprime mortgages and opaque, exotic derivatives flooded the market, crowding out traditional lending and inflating hidden hazards. Too big to fail entered finance. Megabanks grew so tangled with markets and governments that any collapse threatened to shake the global economy. Yet soaring profits masked mounting hazards. Risky leverage and housing bubbles swelled until, in 2008, the global banking system finally buckled. The 2008 global financial crisis, triggered by subprime mortgage defaults, a cascade of bank failures froze credit, crashed markets, and plunged economies into deep recession. Lehman Brothers collapsed in 2008, triggering a wave of panic that spread through global finance and exposed deep cracks in the banking system. Trillions in value were wiped out during the crisis, forcing governments worldwide to bail out major banks to prevent total financial collapse. Citizens lost homes, jobs, and faith in the financial system as the crisis exposed deep flaws in banking, triggering anger, protests, and reforms. The aftermath sparked global protest movements like Occupy Wall Street and led governments to impose new regulations on reckless banking practices. As banks grew larger and more powerful, people began to ask a hard question. Do banks exist to serve the public or to control the system itself? Conclusion: from medieval merchant guilds to towering skyscrapers on Wall Street, banking had transformed into a powerful global financial network. The 20th century made banks more powerful and more fragile than ever as growth, risk, and global ties exposed them to massive booms and busts. But a new era was beginning, driven by decentralized finance, mobile apps, and AI, reshaping how people access, manage, and move their money. Could banking survive the digital revolution, or would technology redefine money, security, and the very role of banks in everyday life? In the next part, we'll explore what's next: cryptocurrencies, neobanks, digital assets, and how tech is redefining the future of banking.
Hello everyone. I am very excited to share my new YouTube video with you, and I need your support to continue to bring quality and enriching content. If you enjoyed my content, please help me by like the video. It helps me reach more people and spread the message. Subscribe to the channel using the subscribe button below so you don't miss any new update or video. Press the bell to receive notifications every time I upload new content. And if you would like to support me directly and help me create more content, you are welcome to join me on Patreon. Your support is significant for me and allows me to continue investing in creating quality and enjoyable content for you. Thank you so much for joining and watching. I appreciate it from the bottom of my heart. See you in the next video.